everyone, welcome to Vortexa's January 2025 edition of MENA Energy Insights. I'm Jay Maroo, and on this edition, we're going to go through some of the most important oil and shipping issues for the Middle East and North Africa region. So, some of the important things we're going to talk about in this edition are our initial take on what's happened with OFAC sanctions and the impact of global crude supplies. We're also going to give you some thoughts on early indications when it comes to tanker activity, in particular, some of the flows that we see from Saudi Arabia to China and India, and also other Middle East regional exporters. We'll also touch on what's happening at Saudi Arabia's Jizan refinery, the impact of refinery maintenance there, and at a broader level, Middle East diesel exports pivoting towards the west of Suez. And then finally, we're going to also touch on some of the most interesting flows that we saw last year when it comes to cleanups on super tankers and how things could pan out for this year. So without further ado, let's get started with the most important issue of the day, and that's the latest sanctions by the US Office of Foreign Assets Control, or otherwise known as OFAC, on a vast fleet, which is used mostly to carry Russian crude oil. Now, when it comes to the volume of tankers that have been affected by this, there are over 100 tankers that have been sanctioned by OFAC. And clearly, one of the key questions in the market is how much impact will this have on global crude supplies, on global crude trade, and could we see a massive shortfall? Well, having done some initial analysis here at Vortexa, we've crunched the numbers, and what we've come to a conclusion to, at least at this stage, is simply that Russian oil supply is too large and it's too important given where we are with global supplies. What we think is some supply may be delayed, some cargoes may be delayed in discharging, but ultimately we cannot really expect much Russian supplies to be lost. And the reason for that is clearer on this right-hand side chart, where you can see just how important when it comes to Iran and Russia, their crude supplies are to the market. So collectively, they contribute almost 6 million barrels a day to global crude exports. And when you compare that with how much comes out from the other supplies and how much has been lost from other suppliers since 2018, you can see just how important that sanctioned flow is from both Russia and Iran. Now, what we see happening is that these tankers that have been sanctioned by OFAC, they will almost certainly no longer operate when it comes to international mainstream market, and that is actually a bullish factor for global freight rates and for other mainstream tanker operators. However, what we think will happen is that Russian crude oil will continue to flow to China, India, and Turkey, and that will have to happen through a mixture of new tankers joining this grey fleet and also adherence to the price cap when it comes to Russian crude exports. Another point I want to mention here is just a comment on spare capacity. So one important point to mention here is when it comes to Saudi Arabia and the UAE, who are often touted as the main sources of spare capacity in the global market, when we see what their seaborne exports have been doing, we can see they're only 1.5 million barrels a day lower than where they were at their peak in 2018. So when it comes to how much oil can actually get into the market, into the seaborne market quickly, outside of Saudi Arabia and UAE, clearly there isn't that much more that can be added quickly. And that adds more weight to our case that Russian supplies are likely to continue going forwards, maybe with some slight disruption. So let's look further into what the impact is of that disruption, particularly when it comes to freight rates. And here it's quite clear on this right-hand side chart, on this red line, you can see there's been a clear spike in freight rates, and namely the TD3C freight rate, which represents the cost of freight for a VLCC from the Middle East to China. What we can see is since sanctions were announced, freight rates spiked up, and that was on the back of ship owners capitalizing on a situation of uncertainty. But actually, those sharp rises in freight rates, they've been somewhat short-lived, and we can see a relatively quick normalization to slightly higher levels rather than massively higher levels when it comes to freight rates. What we've seen and what we've heard from the market is that Chinese and Indian refiners are looking to secure Middle East crude, especially in February. But what we think is likely to happen is that will be a short-term buying program, and going forwards, as the new fleet or the new grey fleet develops, as price cap adherence kicks in more and more, Russian crude will continue to flow, and there will be another rebalancing taking place later down the line. It's important to note, however, when it comes to current indications, especially for VLCCs, we do see an increase in non-stationary ballast tankers moving globally. And that's what this blue line on the right-hand side chart represents. So we can see more and more VLCCs really moving and increasing their mobility. And that suggests a busyness, a level of activity. And we can see that that's not really replicated to the same extent for the Aframax classes, which is a class mainly used for Russian crude exports. What we do also see is an increase in VLCCs and Suezmaxes heading to some of the key locations to load crude globally, whether that's in the Middle East or to a lesser extent West Africa and the US Gulf Coast. If we move to the next slide now, we'll dwell a little bit specifically on the case of Saudi Arabia and see what's happening with their exports in January. So what we've got here is a chart showing Saudi crude exports to China on the left-hand side and India to the right-hand side. And the bars represent the exports by Saudi Arabia for the first 20 days of the month. The blue dot represents the exports for the first 10 days, and the red dot represents the level of exports since sanctions have come in. And it's important to note here that while many may talk about an increase in loadings by Saudi Arabia to China and to India, actually those increase in loadings happened prior to sanctions coming in, where you can see that blue line well above. And what we think is actually happening here is probably some front loading to the monthly loading schedule, i.e., more cargoes loading in the first half of the month rather than second half of the month for scheduling reasons. And that seems to make more sense rather than any kind of real pickup in Saudi crude loadings in January on the back of sanctions. What we think is likely to happen is that loadings will pick up maybe in the preceding weeks and months based on the fixing activity that we talked about in the previous slide. But when it comes to January loadings, actually, we don't see any major indications of an increase in Saudi crude heading towards China or India. Now, when we look at other regional producers across the Middle East, we can see different trends depending on the producer. So in the same way where we looked at crude exports for the first 20 days of the month and then compared it to exports the first 10 days and second 10 days, when we do that per producer, we can actually see really it's only Iraq and the UAE that have raised their crude exports since the January 10th sanctions kicked in. Now, Iraq has picked up exports fairly significantly, but the UAE, it's been very marginal. As for other producers, Kuwait slightly down and Qatar slightly up, but no real meaningful difference there. And actually, when you compare the change in the first 10 days versus the second 10 days for the other producers, they're pretty much offset when it comes to the drop off from Saudi Arabia. So when it comes to total Middle East crude to places like China and India, we haven't really seen that uptick yet, but we may do in February. Now let's move on to the issue of refinery maintenance, and namely refinery maintenance at Saudi Arabia's Jizan refinery. So this refinery is a really important refinery, and it's going under a full turnaround from Jan. And what that means is basically lower refined product exports, and we can see that already emerging in our January data. On the left-hand side chart, we can see quite clearly there's been a sharp drop-off in total refined product exports, and diesel exports have all but vanished. And as for other products, gasoline and residual fuels, they have also shrunk as well. Now, it makes sense to understand with this refinery turnaround in place across January and February as well, which regions are likely to be impacted and for which products. And that's what we can see quite clearly on this right-hand side chart. We can see actually there's a fairly broad split when it comes to the impacted regions. So when it comes to gasoline, we can clearly see Southeast Asia is heavily impacted by the loss of Jizan production. But when it comes to diesel, we can see a mixture, mainly being impacted in the Med and Black Sea, but also to some extent in Northwest Europe as well. Another important point to note here is actually when it comes to Jizan's residual fuel oil, slash VGO exports, we can see the Northwest European slash Baltic region has an outsized impact here. And that would seem a little bit odd at first, but actually what has been seen in our historical data is cargoes from Jizan heading to places like Sweden and Estonia in the Baltics. And these are regions that would have previously taken Russian fuel oil and Russian VGO. So now let's move on and expand on what's happening with Middle East diesel exports more generally. And if we zoom out to a wider trend, we can actually see exports have really picked up, especially towards the start of this year. On the left-hand side chart, we can see total exports from the region are actually at a very, very high level, nearing 1.8 million barrels a day. And Saudi Arabia has been part of that despite Jizan being under maintenance, but we've also seen an uptick in exports from the likes of Kuwait and Oman as well. Now, when it comes to total exports, yes, they have gone up, but actually what's even more interesting is the pivot in exports that we've seen, and that's made clear on this right-hand side chart. So we can see this sharp recovery when it comes to Middle East exports heading towards the Atlantic Basin, and moderation when it comes to flows that was heading towards the Pacific Basin. Now, we think this could actually continue, and it could even maybe be supported in the preceding weeks and months, especially if the risks of transiting through the Red Sea decline, and maybe we start to see some Middle East producers start exporting their diesel more keenly through the Suez Canal, which would massively cut journey times and freight costs as well. So the last thing I want to talk about in this edition is the issue of supertanker cleanups. What we saw across most of last year is a lot of activity where older tankers previously plying crude and dirty petroleum trade would clean up and start moving into trading diesel, jet fuel, and moving that from the east to the west. Now, what we've seen in January is a grinding to halt with that activity, and there's a few reasons why that's happening. So obviously on the dirty side of the market, we've seen VLCC rates pick up sharply, and that's really limited the spread between clean and dirty, and therefore disincentivize any kind of switchover activity. But what we've also seen is that the east-west flows are opening up when it comes to arbitrage, and that's supporting LR2 activity as well. Now, what could happen is this could reverse, especially if Greek and EU Aframax operators start stepping into the Russian trade to replace the sanctioned fleet. And that could see some more LR2 switching back to dirty, which could tighten the clean LR2 fleet. However, what we do see, at least for this year, is that there are more Suezmaxes hitting the water, new builds. And these new builds are likely to pick up clean cargoes such as diesel for their first maiden voyage. And that will travel from east to west. And that will naturally hit LR demand as well. So with that, I'd like to conclude the January 2025 edition of MENA Energy Insights. Thank you for joining and look forward to seeing you on the next edition.